Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
All right. Well, once again, everybody, I'm Brian Fouts, and welcome to this presentation. Now, one thing I do want to note in the presentation, there's nothing to purchase here. There's nothing to buy and that kind of stuff. I'm here to give you some very phenomenal content, which obviously a lot of you know what this is, but let's go ahead and get started. So I got a quick question for everybody here. So what in life should you control? Now, there's three things that I like to talk about when it comes to things that we should control in life. So use that chat box. What are some things that you believe that we should control in life? Time? Absolutely, Mark. Time is a very powerful one. Time is an amazing one. Anybody else? What are the things besides time might we want to control? Emotional decisions? Yep. Mindset, money. Okay, I love these. Thoughts, taxes. Yeah, wouldn't that be great? Well, I mean, moving out of California, that's one way to control taxes, right? Health, Frank, that's a great one as well. Our world. So yeah, there's the three things, and they were all mentioned right there. Now, the first one we talk about is going to be money, right? We all say we want to control money. Okay, that's something that a lot of us, by the way, don't control. If you're trading, time for money, what is money controlling you? Are you controlling money, right? Next one, of course, is time. Time is that one thing that once it's gone, it doesn't come back. Money, by the way, we can lose it, we can gain it back, but time, once it's gone, it's gone. And the last thing, of course, that we have to control before these two is the mindset. Our mindset around time, our mindset around money is something that a lot of us don't really think about, and it's being controlled by other people. Are we in the driver's seat of our mind or not, as an example, right? So when I think about controlling my mind, I think about money, right? How do I control money? Because once I control my mindset, I can control money, then I can control time. That makes sense? So three things we're going to be talking about here today in this presentation is one is how do we control our mindset? How do we look at our mindset? We're going to look at how do we control our money as well, because then the end result is you can control time. All right, now I want to share with you a quick quote. This is one that we here at the Money Multiplier like to share quite a bit, and it's by Will Rogers, and it says that the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Now, what I mean by that is keep an open mind. As we go through this presentation, just keep an open mind to the concepts that we're going to be discussing and sharing here. So just keep that open mind. Now, I want to share something here. So let's say that you take 100 18-year-old kids, right? 18-year-old kids, and you put them in a room and you ask every single last one of them, where will they be when they retire? Okay, what are they going to be? Are they going to be successful or not? Of course, all of them are going to say, yes, I'm going to be a millionaire. I'm going to be very successful, all that kind of stuff, right? I probably would have said the same thing when I was 18. But here's the thing. If you fast forward to when they are retired, okay, the fact of the matter is that only 5% of those 100 kids are going to be financially secure in retirement. And that's crazy, by the way. Here in America, the one of the wealthiest countries in the world, how is it that only 5 out of 100 people are going to be financially secure by the time of retirement age? Now, one of the reasons why is because we're taught lies around how money works that keep us in that 95%. So we want to be part of that 5%. Okay. But once again, it's that mindset. As we go through life, the system, as Grant and Jared mentioned right there, we are taught a wrong way of thinking about money. That's what happens to us. And so that's why these concepts we're going to be discussing here today are so important, because let me ask you a question. Do you want to be one of the 5%? Do you want to be in the 5% or the 95? Give me a one in that chat box if you want to be, part of that 5% or 5 out of 100 people that is, by the way, not like financially free, just secure in retirement. So, I mean, do you want to be one of those 5 people? I mean, if you're here on this presentation, I'm assuming the answer is yes, obviously. There you go. Jared said, yeah, definitely. Secured retirement. Yep. There we go. Now, here's the thing. That statistic that I just gave there, it's actually coming from the Social Security Administration. They're the ones that say that only 5 out of 100 people will be financially secure at retirement age. So let's see how we can be one of those 5%. Now, real quickly, guys, you don't know me. So my name's Brian Fouts. I actually went to college to get a degree in construction management. I followed that traditional path through life. I did what I was told. I did what those ahead of me had done. I did what everybody around me was doing. Go to school, get a job, all that kind of stuff. And I just thought that was what I was supposed to do. I call that the hard way, by the way, now, because I was raised, lower class, and I was told go to school, get a good job, save into the 401k, all that kind of stuff. And that's exactly what I did. And unfortunately, I had all the trappings of middle America, right? I had the house, I had the car loans, the mortgage, the growing family, all that kind of stuff. But something just didn't feel right. I was told I had the American dream, right? Everybody says, oh my gosh, you've got the American dream. But it didn't feel that way. In fact, at a point, it felt like the American nightmare. And there was this time where I was at a doctor's office, and there was a financial magazine on the kind of coffee table there, and I picked it up, opened it up to this article, and it was talking about wealthy people, and it was said that the wealthy individual knows their net worth, or the average millionaire knows their net worth. And I realized I didn't know mine. I was like, oh shoot, I'm not one of those. So I went home and I did the math, and I have a picture of the paper that I did it on right there. I was worth a negative amount of money. I was like, what the heck is going on? I've been working for 10 plus years in this industry, but I had a negative net worth. It made no sense. And when I did the math, I was going to keep actually digging a hole in debt. And then what happened though is my grandfather, my idol, somebody I looked up to, he's working his entire life as a coach at a local high school. And then he retired, and he was so excited to retire. He was like in his late 60s, and he was saving up all this money. My grandmother and him are going to go buy this motorhome and travel around, do all these cool things. And they did that. They actually did it for about a year and a half, I think. And then he got real sick. He got Parkinson's, leukemia, and ended up unfortunately passing away. Never got to enjoy that life in retirement that he was so looking forward to. And it really had a big impact on me. And I said, hey, if I want to do something, with my life, if I want to have that experience and all that kind of stuff and that freedom, I got to start now. So that's really what set me on that journey. And I left the industry, I left construction, got into entrepreneurship, got into business ownership, all that kind of stuff, and built a couple businesses. This is one of my businesses, because anybody can say anything on the internet, by the way. But this was my 2021 tax return for one of my businesses, did over a couple $1 million in revenue. Real exciting. That was an Inc. 5000 business right there. And so I kind of learned what was possible, and that allowed me to live a life where I control one thing. For me is time. I love to control time. That's allowed me to do a lot of fun things, have a lot of experiences. I like cars, you guys can't tell. And so that's what I do. And I now help people learn the same concepts and the same things that allow me to control my time. I speak in front of groups, I speak on stages. I'm speaking to you right here is now. And this is my passion, is sharing these kinds of things. All right. Now, along that journey, though, I came across a concept, and this is what we're going to be talking about here today. And it has completely transformed my life, my family lives, and thousands of other people that I personally worked with. And of course, at the Money Multiplier here, we help people do this every day. Now, who else is talking about this concept? Now, this is not a new concept that we're going to be talking about. In fact, Robert Kiyosaki, in his book called Second Chance, he talks about this concept. By the way, I recommend these books that are very good just to expand your knowledge, right? That mindset thing. Tony Robbins, Money Master the Game, he talks about this one in that book as well. And then, of course, Becoming Your Own Banker, Unlock the Infinite Banking Concept by R. Nelson Nash. I strongly recommend that book right there, because it is the foundation of how we do this concept. Also, one of my mentors, Chris Naugle and Brent Kessler, they have a book called Mapping Out the Millionaire Mystery. If you guys want that one, by the way, in PDF form, I have that one. Just send me an email after the presentation. I'll send you a copy of the Mapping Out the Millionaire Mystery in PDF form if you want it. And then of course the private money guide, I think I have that one as a PDF as well. So if you guys want that one, just let me know. I'll put my email address here at the end, and I'll give you guys those ones as PDFs if you guys want those books. But yeah, strongly do recommend these books. They're great ones that talk about this concept. Okay. Now, let's kind of talk about real quickly who has used this strategy throughout history, because it is not a new concept. It's been around for a long time, a couple hundred years to be honest. So who else has used this? Well, Jim Harbaugh, how you say his last name. So they use this concept, dividend paying life insurance, right, to make him to help with the bonuses and the pay him. They use this concept, so it's very versatile. But yeah, the college used this concept when they hired him. This guy, you guys might know him. He might not know who he is anymore, but current president Joe Biden has 4 of these things in his life. He had to disclose that when he became president. Walt Disney. So this is really cool. So Walt Disney, he was trying to start Disneyland, right? And he couldn't do that because nobody would give him financing. And so he used his own private financing system, the infinite banking concept, to start Disneyland. So without this concept, Disneyland or Disney World might not exist. It's kind of cool. Also, Ray Kroc, so when he partnered with the McDonald's brothers and eventually took it over, he used this concept to pay for like employee salaries and expenses during the startup period of McDonald's. And so without this concept, McDonald's, as we currently know it, might not exist either. The Pampered Chef, she borrowed from one of these concepts to start that company. And then, of course, Warren Buffett got it for, I think it was 1.5 billion. Pretty cool. And then, of course, lots of wealthy families have used this concept for a long time. So the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers, Harrises, all those families can do it. And obviously, you as well. Now, let's kind of talk real quickly about what infinite banking will do for you. So day 1, not day 30, not year 30, it creates guaranteed generational wealth, tax-free, by the way, day 1. That's a pretty cool benefit right there. It allows your money to grow uninterrupted compounded. We call this uninterrupted compound interest for the rest of your life, guaranteed. Like I want to note that word guaranteed down there because it is very powerful, but also uninterrupted compounded interest is amazing. And we're going to show you some examples of what that looks like. It allows you to take control of your money away from the big banks, away from Wall Street, and puts the control into your hands, right? Remember, we talked about control at the very beginning, control of money, control of time. This puts control of your money into your hands, not the bank's hands. It protects your money from lawsuits, from creditors, divorce. In most states, by the way, it allows you to be the bank for things that you may normally use a bank for, such as, investing into real estate. Maybe it's college, maybe it's cars, homes, investments, retirement, while still having all the benefits listed above. It's not 1 or 2 of these things. It's all of these benefits at the exact same time. Now, give me a 1 in the chat box if you want to have all of these benefits in your life at the exact same time while being your own bank. Give me a 1, give me a yes, give me a Y in that chat box. Okay, maybe, says Grant. Ann says yes, Mark says yes, Kathy says yes. Absolutely. Hey, Tess, how you doing? Tess is one of our clients, by the way. So she's also actually on our team too. Yeah, Sandy. Okay, cool. Awesome. Yeah, so that's why this is pretty powerful. When you look at a lot of other kind of concepts or strategies or opportunities, they might have 1 of these things or maybe 2, right? But with this one, it does all at the same time. That's why we love this. So let's kind of get into some of it. Now, by the way, if you guys want to take notes, use the chat box if you guys want to, but I definitely do recommend taking notes on this and then reaching out if you have any questions later on, because sometimes people have questions later on. Now, let me ask you a quick question. Who learns quickly? Yeah, who learns quickly? Kids learn quickly. By the way, I have 3 kids. Oh my gosh, my 13-year-old is going to turn 14 this month. Oh my gosh, it's crazy. My son is going to turn 12 here soon. And then my other daughter, she's going to turn 9 here this month as well. So yeah, they learn quickly and they grow quickly. But here's the thing. So you probably learned how to ride a bicycle when you were little. And even if you haven't ridden a bike in a long time, you can always hop on that bike and you can just kind of start pedaling and you pick it back up pretty quickly, right? Now, what would happen if the bike did not work the way that a normal one does? What if when you hopped on the bike and you turned the handlebar to the right, the tire went to the left, and you turned the handlebar to the left, but the bike went to the right? So there's a video of this online. It's called the backwards bicycle. Go look it up after this presentation. It's hilarious because the guy gets on the bike and bam, immediately falls over, can't get the hang of it. But here's the thing. He practices and practices, and eventually he can ride the backwards bicycle. He turns to the left, he can keep his balance, all that kind of stuff. Yet here's the crazy thing. When he gets on a regular bicycle after the fact, he can't ride the regular bicycle anymore. It's pretty funny because he got used to the backwards one. So money is the same way. That's the kind of the analogy I'm making here, is that we learn how to ride a bike, or we learn a certain way around money. But once we learn how the money really works, the backwards bicycle, it's very hard to go back to the other way of thinking about money. So that's why I said, one of the first things we have to control is our mindset. You got to control that mindset. Then you can start to control money and time. So let's talk about why more people are not successful, the mysteries of money. So these are some of the wealth killers out there. Taxes, by the way, taxes just bleed your wealth away. Inflation. Inflation, they call that the hidden tax. Well, inflation, by the way, is not rising prices. Inflation is the inflating of the money supply, which, by the way, is printing money. The government does that, and the banks do it as well, results in rising prices, okay? Volatility, the ups and downs of the markets, those things erode your earnings. They erode your ability to have consistent growth of your capital. Interest. So this is pre-COVID, by the way. Pre-COVID, the average American household paid, I think it was $19,000 a year in interest. And it's probably gone up in the last, handful of years, right? And so if you're paying money to other people, making other people wealthy, they're making them rich, that's eroding your money, okay? Mindset. So following that status quo, right? Fear around missing out, by the way, is a huge destroyer of wealth because we jump into things without really knowing what we're doing. Think of like crypto, right? Life happens, right? So life controls our mindset unless we control it. And then of course, what we're taught, the system, somebody mentioned that before, the college system, the educational system here in the US is designed to make worker bees, employees, right? Yeah. And Mark said nothing backing currency. That's fiat currency, by the way. I do presentations on that as well. But yeah, I mean, we have these dollars that are literally backed by the government's promise. That's a kind of a scary thing, by the way. But yeah, we don't control the money. They do. Okay. Unions. Yeah. Unions. I believe me, I've was in construction. I dealt with the unions a lot. Definitely have a different mindset. All right. So we'll talk about what's the definition of money, by the way, since someone mentioned, nothing backing our currency. We used to be backed by the gold standard, right? Not anymore. And there's no country in the world that is really backed by it. Yeah. Full faith and credit of the government. There you go. That's what Mark just said. So what is money? So money is just a means of an exchange. Yeah. It could be seashells. It could be dollar bills. It can be, it could be whatever, coins. It's just a means of exchange. Now, think about this. What company uses compound interest? Now, I would have always said, well, banks do that, right? Well, guess what? Do banks use compound interest? No, they don't. They charge you interest, but they don't use it themselves. Like if you write your name on a $20 bill and you give it to the bank teller, they don't go put it in a box with your name on it. They don't do that because they have to make money. So what they do, they put that money into motion. That's what they do. Money in motion makes money. It's one of the things I always say. So once again, money in motion makes money. Banks put your money into circulation, which we're going to show a little bit here in a moment how they do that. Are your dollars worth more today or in the future? So think about this. If you had a dollar bill 20 years ago, could you buy a candy bar? Probably buy a couple of them, right? Now, maybe half a candy bar, maybe a quarter of a candy bar, right? So your dollar is worth more today than it is in the future, okay? Do taxes go up or down? Now, kind of a goofy question, but yes, the taxes typically go up. So here's a great question. And this has to do with other different types of financial vehicles, but this is a good one to think about. Would you rather pay taxes on the seed or the harvest? What I mean by that, let's say you buy some corn seeds, right? You plant them, they grow, then you go to sell your crop. Would you rather pay taxes on that seed, the initial, or on the harvest? Yeah, Tessa, the seed. Exactly, right? Well, guess what? What does the IRS want you to do? They want you to pay taxes on the harvest. Think about a 401k, tax deferred. Take it out, more taxes on a larger amount of money versus paying it on the seed. So in this concept we're going to be talking about here today, we want to pay it on the seed and then have tax-free growth. Yeah, Anthony, IRS wants both. Yeah, they do. And they will try to get it as much as they possibly can. Yep, exactly. Okay. Now, This is an interesting question as well. Would you wait to eat bread or drink milk? Or would you drink it today? No, of course you're not going to wait to drink the milk or eat the bread. You're going to buy it today and eat it today. You're not going to wait for down the road, right? As an example. Now, it's the same thing. Would you go buy a car and then wait 5 years to drive it? No, of course we wouldn't do that, right? We're going to eat the bread today, drink the milk today. But here's the thing. We do things with our money, right? We put it into these other vehicles and then we wait 20, 30, 40 years to use it. But we wouldn't do that with things that money buys. What does money buy? It buys a house, it buys food, it buys a car. Are you going to wait to use those things when you buy them with that money? No, you can use them right away. So we want to do the same thing with our money. We want to use it right away, but also have it for down the road. Okay. So yeah, think about that for a second, because we do things with money that we don't do with things that money buys. And that's a backwards way of doing it because that's what we're taught. So once again, keep an open mind. And then what do you know about your retirement account? So what I mean by that is, who controls your money? Is it you? No, in most cases, it's not. It's the banks. It's the 401k custodian, by the way. It's the markets. It's Wall Street. They control that right there. So can you lose your money in those accounts? Absolutely you can. In fact, when I had a 401k, this is many years ago now, I watched it go down by 40% in a matter of months. I mean, it just plummeted. Then it took, I think it was 5 years, something like that. Yeah, I think it was 5 years for it to get back to where it was before the crash. Like, that is insane, right? So we want to control our money today and also down the road, okay? Now, I know what I threw a lot at you, but once again, I want you to start seriously thinking about what you do with your money. Because up until this point, we've just accepted the traditional way of thinking about money. But to build true generational wealth, you have to challenge those old concepts. You have to start thinking a bit differently about it. Once again, keep that open mind. All right, let's kind of talk really quickly about how money flows. Okay, I'm going to keep this pretty simple, but let's say you're going to go buy a car for $25,000. Now, don't get too hung up on the price. Maybe it's a used car, whatever it is. Doesn't matter if it's a Honda, Maserati, Ferrari, or a Cougar, right? Now, let's say you have $25,000 in a local bank and it's earning, let's say, 4%. And you're going to go to that bank and you're going to take the cash out to go buy the car. But let's say I'm your banker or Banker Bob, and Banker Bob says, hey, wait a second. Before you do this, before you come and take the $25,000 out of the account that's earning 4%, that's awesome right there. What if I do something different? What if you leave the money in the bank, okay? And then the banker, is going to give you a loan for $25,000 and use the $25,000 of cash as the collateral, okay? So what does that look like? So you've got a loan, let's say it's for 60 months, 5 years, and the banker is going to give you a 6% simple interest rate on that loan. You're also going to be earning 4% on the $25,000 for the same period of time in the bank. Okay, so what's that look like? Your monthly payments back to the bank on the loan is going to be $483 and change. Okay, future value of all those payments back is going to be $28,999, or just round up $1, $29,000. Okay, that's the future value of the payments back to the bank. But the future value of the $25,000 is earning 4% over the same time period is $30,525. So you've essentially made $1,526. You've made money. But then someone says, well, yeah, but Brian, but I had a monthly payment. If I paid cash, I wouldn't have the monthly payment. I get that question a lot. Let me explain this to you. If you took $25,000 out of the bank as cash and bought the car with cash, you don't have the cash anymore. Right? It's not working for you. The bank has it, or the car company has that money now. Here's the thing. If you want to save up that money again, what are you going to do? You're going to pay cash, and then you're going to put money back into this bank account again to replenish your cash savings. It's the same thing. The money flow is the same here. Okay. And so if this isn't quite clicking just yet, stay tuned. It'll get a little bit better. And so, Mark says, buy used car, fix up, save payments of new car. I mean, Mark, I've done that before too. I've done it both ways. But yeah, but Anthony, uninterrupted compound interest. Yeah. So that's what you're seeing right here on the screen. The $25,000 is earning you 4% compounded, uninterrupted, and yet you're paying 6%. So how is it that you made money earning 4% while paying 6%? For some people, that doesn't make sense. You're paying simple interest, you're earning compound. One of the golden rules of investing, earn compound, pay simple, because the math, it works. Math is math right there, right? Okay, so the money multiplier method. So this is what we're going to be covering here moving forward. So one is the machine. What is the machine that allows this to work? Okay. Next, we're going to talk about the marathon, because this is not a sprint, it's a marathon. Building wealth, it's not overnight, right? It takes time. And then, of course, everybody's favorite topic, the millionaire. How do you use this to build lasting wealth today and in the future? All right, so let's talk about the machine. So the machine is nothing than this. So think of infinite banking concept. That's what we're talking about here today. That is a car. But what is the machine that allows it to go down the road? It is nothing more than a dividend paying permanent whole life insurance policy from a mutual insurance company. Mutual meaning that you are a part owner of that company. So once again, think of the infinite banking concept, the bank, as a car. It has tires, wheels, brakes, windshield wipers, seats, a radio, okay? But what makes that car function? What makes it go down the road and allow it to, move? It is the engine. So the engine is a life insurance policy specially designed for this concept, okay? Bank-owned life insurance. Now you might be saying, well, Brian, why are we talking about life insurance? I don't, that doesn't sound like very much fun. Oh man, it's a blast. It's amazing. So who invests into life insurance? So we do, but guess who the biggest buyers of life insurance is? It's banks, by the way. Banks are taking your money, by the way, that you deposit with them. They're turning around and they invest it into life insurance. It's called Bullet. You can go Google it, by the way. It's called BOLI, Bully. You can look at it. They buy tons of this stuff with your money. So one of the things that we are doing is just doing the same things that banks are doing with our money in the first place. Yeah. Yes. And by the way, banks own more life insurance than they do their buildings and land combined. Do you think they know something that the average person doesn't? Absolutely. Absolutely. Yes, they do. So once again, we're bypassing the banks and doing the same thing. Okay. So we already went through this once. We showed you the math here of how you can make more money earning 4% while paying 6%. Okay. So now let's kind of talk about how the banks make money off of your money, because we have to understand how banks function to really make sense of why we want to become our own bank. So now, before I get into that, I want you to understand one thing. In this situation right here on the screen right here, you have a cash in the bank and you have a car loan from the bank as well. Who's in control? Who's in control of the money in that situation right there? Anybody want to use a chat box? The bank. Yes, Kat, yep, Anthony, yep, the bank controls your money. So one thing we're talking about here, I talked about at the beginning, is control. In the infinite banking concept, you're in control of the entire thing you see on the screen. That is a massive change. It's a shift. When you are in control, like a bank is, you benefit the same way a bank does. So let's look at how a bank deals with your money. Okay. So let's just assume that you come in and you deposit $100,000 with a bank, and they're going to pay you, let's just say they're going to be very nice, pay you 4% on that money. Now, a bank has to pay you 4% because that's a liability for them. That's a liability. So do they just sit on your money? Absolutely not. What do they do with it? They take it and they turn it into a lot more money, by the way, money printing, but they lend it back out. Let's say it's on a home, maybe it's a 7% rate, whatever it is, a HELOC, something like that. Now, when that happens, does the money just sit with the home seller or buyer? No, of course not. The seller of the home takes the money and puts it back into the bank. Yes, Anthony, fraction reserve lending 9 times. Yeah, pretty scary stuff. But yeah, so they put it back into the bank. Now the bank receives that money back again. Do they just sit on it? Absolutely not. They lend it back out, maybe on a car loan. What's the car company do? Puts it right back into the bank again. Okay. They loan it back out for a home remodel. Okay. The contractor, the employees, the material, all that kind of stuff. Where does it end up going? Right back into the bank again. They lend it back out maybe for debt consolidation at 12%. What's the credit card company do? Puts it right back into the bank again. So the bank is in control of all of these transactions. So they have one liability, which is your deposit. They turn that into assets. The home, the car, the home remodel. Those are all assets for the bank because they have a loan out there. It's a liability for other people. Okay. A car loan, a home mortgage, right? A remodel loan, debt consolidation, those are all liabilities on our books. It's an asset on the bank's side, okay? So the banks can, if you do the math, they make around 500% more than you do on the same money that you put into the banks because they're just repeating that. They're rinsing it and repeating that process over and over again. So they make a lot of money. Now, if you don't believe me, just go to bauerfinancial.com and you can go look at any period in time and see how much the banks make on the money that you leave there. And if I remember correctly, it's like banks have never made less than 400% on the money. So that's why banks have these nice buildings and all the kind of stuff, because they're making a lot more money off of your money than they're paying you for that same thing, right? Okay. So that's how banks function, right? So we're just talking about taking back control of those banking functions in our lives. So let's look at the annual pattern of spending. Now, this is one of the mindset things that when I learned this, it really kind of made my eyes kind of get wide. It's like, oh my gosh, it's very true. So let's look at how most people spend their money. So let's say a dollar comes into your household, okay? Dollar comes in. Now, 20 cents of every dollar goes to automobiles, payments, gas, tires, etc. 30 cents of every dollar goes to housing, okay? 40 cents of every dollar goes for everything else. Think of things like travel, entertainment, food, groceries, stuff like that. So 90 cents of every dollar goes to other people, by the way, and only 10% goes to our savings. Now, about 3 years ago, the average savings was about 5 to 6%. And then before the COVID and stuff, it was a negative amount. It was a negative number. That's crazy. And so let me ask you a question. So when you go to a financial planner or a financial advisor, do they talk about your automobile interest, your housing interest, the interest going to these things, or do they talk about your savings? So my personal experience when I did work with a financial planner is they would talk about my savings, right? Oh, let's get a better rate on your savings than you're making. Let's maybe take some more risk in the markets to, make that savings grow better for you. Well, bottom line is I took a lot of risk and I lost a lot of money. When the markets went down, I lost a lot. They came back up, but it took 5 years. So here's the thing. We're not going to talk about the savings right now. Rather, though, what you're spending the money on and then taking control of some of that money, interest, by the way, and putting it back into your savings. That's really what we're going to be talking about here. Okay, so let's start with this. Okay, so savings, 10%. Now, as I said before, 20 cents of every dollar that you earn goes to your car, your automobile. Now, 5 cents of that 20 cents is interest, okay? So let's go ahead and take that 5 cents and put it into our savings, okay? So that's the interest that we typically are paying on cars. Next up is housing. Now, housing, by the way, is 30 cents of every dollar, but 25 cents of that 30 cents is interest. So that's an amortized mortgage, by the way. Okay, so let's take that 25 cents and put it back into the savings. Now, here's the thing. Why is it that much? Yes, Kat, we are going to be talking about the actual machine and how it works and some numbers and stuff, but I want to lay the foundation first. So why 25 cents of 30 cents? Well, an amortized mortgage that's what most people have, is 80% of the first 7 years goes to interest. So you're paying, they're front loaded with interest. So it's a lot of interest that goes to mortgages, by the way. And I can do a whole topic on that if you guys want some of the time. And then of course, 40 cents of every dollar goes to everything else, and around 5 cents of that is interest. So we're going to put that into savings. Okay. So that's how we're doing that. Make sense? So when we take back control of the banking functions in our lives, interest can come back into our hands. Okay. Now let's go look at a real live example of how this looks. So we're going to talk about how to get all the money back for every car you'll ever buy, drive, and own. That is obviously Mustang right there. I don't have mine anymore. I sold mine years ago. I have a Mercury Cougar now. And then Grant said, do I move to lower payments? Interest rates are 7%. We'll get into that, but we need more information on what you mean by that. But yeah, lower payments really is not the way you build wealth. That's what they sell you, by the way. Banks, credit card companies, financial companies will sell you on lower payments. Oh, lower the rate, lower the payment. But really, they're going to make money. And so you got to understand kind of what they're doing behind the scenes. Okay. So let's look under the hood of the machine. All right. So when we talk about the life insurance policies, yeah, $200,000 Eleanor, yeah, probably is Alex. So when we think about insurance, we think of payments. But think of, I got to make this, this expense payment to my health insurance, my home insurance, my car insurance. So I want you to think differently about this. Think of this as premium deposits because you are depositing into your bank and you can use the money. So it's a premium deposit. Okay. So I want to make sure that we're clear on that terminology there. Now, Cat, yeah, it's a 67 Mercury Cougar, by the way. And then Mark, that depends. Depends on what you're paying off. He said best to pay it off, no payments. It can be, but it depends on who's in control. If you're in control, then I don't mind having payments back to myself, right? And then Anthony said, yeah, refinancing. When a bank calls you up and says, hey, refinance your mortgage, get a lower rate, lower payment. That is one of the worst things you can typically do because it resets the debt clock. It resets that interest clock again. The bank knows they can lower the rate 1% or 2%. They're going to make so much more money though over time. So great point, Anthony. All right. So next thing, age doesn't matter. Now, does it matter? Yes, it can when you get up, over 70. But with these kinds of policies, it's not really an age thing. And there's multiple ways to use these. Does not even have to be on you, by the way. We'll talk about that. Death benefit. Now, when you think of life insurance, you think of death benefit, but that's not what we are going to focus on because that's not the focus of infinite banking. We want to focus on the living benefits. So most people don't know that these things, specially designed, have a lot of living benefits. The death benefit is a side benefit, okay? And now, okay, so on the right-hand side here, you're going to see what's called a policy illustration. It's just the numbers as an example. And so we're going to use this as a template for buying cars, okay? So let's look at what this would be for purchasing a car. So we're gonna have a policy, an infinite banking policy. We're going to fund this as an example. This is just for an example for $10,000 per year. It can be 5, it can be 15. It's based upon the individual, by the way. So we're going to put in $10,000 per year annual premium. That is that premium deposit. Okay, we're going to do that for 7 years. Now, when you deposit money into these policies, you're going to get what is called cash value, and that is going to be inside the policy. It's going to grow every deposit. It's going to grow every year from dividends, all these kinds of things. It's going to compound uninterrupted. Now, you can borrow that cash value. That's the big catch with these policies. So let's say at year 3, you're going to buy a car, $25,000. So you're going to have cash value in the policy. You're going to go to your own bank and you're going to get a loan. Now, this is a loan, by the way, that is your loan. It's guaranteed. You don't have to qualify for it, and you control the loan. So we're going to mirror, though, a traditional bank. So we're going to make payments back to our own bank. So we're going to make payments of equal payments of $500 per month, as an example, $6,000 per year. So what does the math look like? So $70,000 has gone in. Okay. You've also paid back into your policy the loan of $30,000 over those 5 years. So you put $100,000 into your policy. Okay. Yet you took $25,000 out as cash. That makes sense? So you took $25,000, you had cash in hands, and you put $100,000 in. So the math is that you funded your banking policy with $75,000. Okay. Here's the thing, though. You've recaptured 91 cents of every dollar you put into the policy. So you've already recaptured your money. Now, it gets better and better as we go on. So I'm going to show you now the next set of years. But real quickly, Norma said I'm 57. Yeah, that's what we're kind of showing you, Norma, right now, is what the numbers would look like. But the numbers depends on what you mean. If you're meaning like face value versus cash value growth, it's going to be dependent upon a few things. It's the person, by the way. So that's what we do is we help, find out what those numbers are. We build those for you. But yeah, we can definitely tell you what those are. Okay, so let's look at the next set of years. So in the next set of years, no more deposits go into your policy. Now you can keep funding if you want to, but in this example, I'm going to just have no more policy or dollars going into the policy. Okay. So let's say though that at year 8, you're going to buy another car. You take $25,000 out of the policy. Okay. You do the same thing. You pay back your policy loan because you are your own bank. You want to be responsible. Pay back that loan at $500 per month. So what's the math? So in the second set of years, the years 8 through 12, you put another $30,000 into the policy. Here's the thing. This is what I want you to understand. Okay. You put 30 in, but you took $25,000 out. So you had $25,000 of cash. You put 30 in. So the net there is $5,000. Now at the end of this 12th year, you have $91,000 of cash value in this policy. Okay. But how much have you put into it? You've put in a lot less than $91,000. So you have $91,000 of liquidity that you can access, and you have 2 cars that you have paid and you have no debt on, and yet you have more cash than you put in. So bottom line is this. Would you guys like to have $23,000 of growth and have 2 cars that you own outright? Give me one in the chat box if you'd like to have that. You have 2 cars that you own outright and you've made $23,000. Kind of simple math. Now that's a very quick example right there, but I want to kind of do the 30,000 foot level, but that's what's possible when you control both sides of the transaction. Yeah, Grant, it's fine. We'll go through some other examples, but bottom line is this, is that when you put the cash into the policy, it grows uninterrupted. It keeps growing. At the exact same time, you're able to borrow against it and use it for other things without losing the growth or the value. So that's very different than the traditional way of buying cars. So that's one example right there. Okay, so there's 3 rules that we talk about with infinite banking. So one is pay yourself first. Okay, so that's the first thing, is pay yourself first. And Kathy, and we're going to go into some more details here. Once again, we're just kind of breaking the ice right now. Number 2, pay yourself back with interest. So one is pay yourself first. We typically, what we do is when money comes into our hands, we pay everybody else first, and then whatever is left is ours, right? So we're talking about pay yourself first, then everything else. 2, pay yourself with interest if you're going to be the bank. And number 3 is recycle and recapture your money. Okay. Yeah. The bills. Yep. Frank. Yeah. The bills. So this works for cars. What else does it work for? So what I want to show you is another thing that really steals a lot of wealth, and that is going to be your debts. Now, after I go through the debts, by the way, we're going to show some actual policy illustrations and the numbers. So if you're like a numbers-driven person, you'll be able to see that visually as well. But debt is one of the more common ways that people do use infinite banking, is to pay back debts. So let's look at an example. So this is an example of a doctor, of a doctor, 45-year-old doctor, male, has 9 third-party debts. Okay, $478,000 in debt. Okay, and so this individual is paying around $5,777 per month, or 69 grand per year. Okay, how long is it going to take to pay all that back? If this person paid this traditionally, just out of pocket every the minimum payments, 19 years. 19 years to pay all of this back. So in this example, in this scenario, this is based upon a case study. This individual is going to do infinite banking first. Okay, they're going to put in $25,000 per year, okay, into a policy. So that's the premium deposit, $25,000. Okay, so day one, this person puts a $25,000 premium into a policy. The cash value inside the policy that they can borrow against right within the first 30 days is around $14,863. That's being very conservative, by the way. Typically, it's quite a bit more, but once again, I want to be very conservative with this example. Okay, so what do? Day one, we borrow from the policy. Okay, we knock out the Discover card, the Lowe's card, and part of the Nordstrom card. Okay, now keep this in mind. Even though this person took $14,000 out of their policy, the entire deposit is still earning dividends and growing uninterrupted, compounded, even though you took money out of it. That's a very important thing to understand here. Now, what happened is his monthly payment went down by $448. So what do we do with that $448? We take that money, we put it back into our bank. Okay, we pay back our bank policy loan. It's called a policy loan, by the way, and replenish that cash value again. Now, that's year one. Let's go to year two. So year two, another $25,000 goes into the policy. The cash value grows by $16,571. Okay, so that's what's available in there. Additionally, the payments of $440 back to our own bank have replenished the cash value of $5,374. So the total cash value inside the policy that he can borrow against right now is $21,945. Okay, what's he do? We take that back out again. We knock out the Nordstrom card, Wells Fargo, private loan, and part of the BMW. The monthly payment dropped by $1,917 now. Now, keep in mind, $3,860 is still going to the debts, okay? So you're still paying the minimums on the remaining ones. But now you're paying yourself back $1,917 every month back to your own banking policy. Year three, same thing. $25,000 goes into the policy. cash value jumps up by, let's say, 25,000 and change. Total cash value, including your payments back to yourself, of 1,917 totals 23,000 and change. So the total cash in the policy now that you can borrow against is $48,545. So repeat the process. Very simple. You borrow 48,000. You knock out the BMW, West Marine, and part of the condo. Your payments drop by $3,677. You pay that back to yourself. Okay. And 2,100 is going to the existing debts. Now, I want to pause for a second here. So what have we done so far? Okay, we've put in $25,000 for 3 years. That's $75,000. We've also loaned out to ourselves approximately $55,000. So the question is, how much is left in the policy? Now, I know that a lot of you know the answer to this question, but how much is in the policy earning dividends, by the way, right now? Anybody want to take a guess who hasn't seen the presentation before? Yeah, so yeah, Kat said 75. That is correct. Some people say $20,000. That's how much is left. Okay. It's not. It's $75,000. That's what's inside the policy. That is what you're earning dividends on. So you're still growing this thing uninterrupted, compounded, even though you've loaned yourself $55,000. You're doing both of that at the same time. Pretty powerful. Okay. All right. Now let's go to year 4. Okay. Year 4, same thing. 25 goes in, cash value jumps up by 26,000 and change. Payments back to yourself is 44,000 and change. Total cash available is 70,000 and change. Okay. So now what do? Once again, borrow from the policy, knock out a part of the condo. Now the monthly payment doesn't change in this example. The reason why is because the condo and the house, those are amortized mortgages. If you pay down the principal, the monthly payment does not change. So in year 4, nothing changes. Now year 5, same thing. 25 goes in, you get the cash value of $27,090. Payments back to yourself, same number, is 44,000 and change. Total cash is $71,225. Now what do? You knock out the condo, knock out a huge chunk of the house. Your monthly payment drops down to $4,556, and you put that back into your policy. Okay. Now, year 6. Now, here's something different. So we kind of throw this in here as sort of a kind of example, but in year 6, what do? We drop the premium down to $10,000 for the first policy. Just as an example, you don't have to do that, but we show it dropping down by $10,000. Now, this is what's very powerful. You drop it down to $10,000, but the cash value grew by 13,000 and change, which is pretty awesome. So, which means you're cash on cash positive already. And then you do a second policy, maybe do it on a spouse or a child or yourself. Premium of $25,000 gets you $14,863 of cash value. Now, your payments back to yourself of the $4,556, that grew your cash value in the first policy by $54,000. So how much cash value do you have right now? $82,000 and change. Okay. What's the debt on the house? It's only $76,000. So what do? You wipe that thing out, your monthly payment is gone, and you are now debt-free from the creditors. Now, what do? In year 7, you take that monthly payment, that cash flow right there, that $5,777, and you pay back all of the cash value on your policy loan. So your cash value goes up again, and now you're debt-free. You have a bunch of liquidity inside your policy, and it's only been 7 years versus 19 years. Okay, so that's an example of how you can use infinite banking to pay off debts. Now you might be saying, well, Brian, that was a lot of numbers. That was over my head. All right, I can't see the math there. But I love the concept. I love the idea of being able to recapture all that money, because now that you've paid off all the debts, what do now? Now you start investing. Now you start building wealth, right? But Brian, how do I do that? Well, we do that for you. So I can't even show you the exact math on all that, but we have software that we've built that will map out the entire process of whether it's paying off debts, if it's investing into real estate, buying equipment. We have software that shows you the best way to flow the money through the policies so that it makes sense, because you don't want to be guessing on how to do that. So yeah, so we have what's called an implementation team or mapping team that really works with you on an ongoing basis to do everything I just talked about. But yeah, so paying off debt is probably one of the more popular things that I run across, because once you pay off the debts, you're debt free, cash has gone up, now you start investing. So pretty cool. Frank says, can you pay ahead in years 2 and 3 or not? there's ways you can, but typically not into the policy. You can't, like, if you're saying if you can pay 3 years ahead of time. Now, the easiest way is to do annual premiums. That's usually the best way. And then you can save it back up. Yes, Anthony, paid up. Yeah, PUAs. That's one of the main features of these specially designed policies is PUAs. Yeah, you have to basically use those for these things. All right. So some other questions that I get right now from a lot of people is like the millionaire is, concept is, okay, what if I don't have any bad debt? What if I don't need a new car, as an example? Because I just showed you those 2 examples. Can I still benefit from privatized banking? Should I still become my own banker? Absolutely, yes, because this to me is where the fun begins, is that once you pay off all these things, now you flip over to the other side and you start acting as the bank and start making money off of your money by putting it to work into other assets. So money in motion makes money. It's why when we talk about infinite banking, we talk about how, when you put your money out there to work for you, are you in control? Yes, you're the one in control. That's how you start building wealth, right? So stop paying money to everybody else. Start earning the money yourself. Robert says, what if you don't have the 25 or 10K? You just do monthly. Yeah, there's lots of ways to do it. And I'll get into some of those numbers and I'll show you some examples here in a moment. Ira says, is this only with premium payments or do we add additional premiums? No, it's however you want. There's lots of ways to structure this. So like if you're thinking, well, Brian, I don't have the lump sum or I can't put in that amount upfront, we work with you on that and we'll show you all the options. But yeah, to be honest, monthly is a very common. That's the more common way to do it. Kat, so paid up additions are just a feature that we add into these policies that allow us to have the cash value right away. Also, one thing I'll mention too, a lot of people have typically heard about this and they say, oh yeah, I've looked at it before, but I no cash value in the first 3 years, didn't really make sense. I would agree with you. So when we do these policies, you have cash value, you can start lending to yourself within 30 days. Very quick, very quick. All right. Okay, so let's kind of talk through some other things as well. So we do have quite a bit of other information I'll share with you. It might clear up some of these questions too. So building wealth multiple ways. So who else uses this? Okay, active real estate investors, wholesalers, flippers, buy and hold. We do a lot of real estate, commercial property. So think about apartments, mobile homes, investment funds, that kind of stuff. Private funds, passive real estate. So lending your private funds out. That's one of the things that we have a group that does that. Business owners, a lot of business owners like to use this so that they can rely upon their own policy, their own banking system versus the traditional bank. So think of like a line of credit for your business. Additionally, if you're a business owner and you don't have like that retirement plan, this is a great thing to bolt onto your business that allows you to start building that money for the future, allows that compound interest. If something happens to you, unfortunately, the business is taken care of, but also you can then grow your business with the same funds you're setting aside for down the road without losing that growth. So that's a very common one right there. We do have some people that do stocks, they do options or traders. They use this to funnel it through first. Startups. So we have some people that are doing startup businesses and they use this as that injection, but they don't want to lose the cash by just putting it into the business. So they put it through the policy first, then they lend to their business and use that. Equipment flipping. This is kind of a funny one, but yeah, we have a group that does equipment flipping. So they're buying like forklifts, renovating them and then leasing them back out. So lots of different ways to use this concept.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.
So what I want to do right now, so I want to give you an example of what that looks like. So this is going to be private lending. So how do you use infinite banking for private lending? So this is an example of a policy. Now, I'm just using some round numbers as an example. Don't get too hung up on the numbers. They're built on the individual. So in this example, so this person is putting in $50,000 a year as a premium, whether it's monthly or it's annual, doesn't really matter, but they're putting in $50,000 per year for the first 10 years. Then we drop the premiums down a bit. So by the way, these are decreasing premiums. They are not increasing. So keep that in mind. They don't go up. They can actually go down. It's your choice, by the way. This person also is doing what we call a dumping or a lump sum PUA. It's an injection they're putting into the policy up front to really get the cash value high, get the dividends higher in the first day one, by the way. It's an optional thing, but this person put in $100,000, okay? So that's why you'll see in year one, the contract premium is $150,000. That's how they funded it. Once again, you fund this, whatever is the best for your situation, and we help you with that. Now, these are all end of year numbers, by the way. At the end of the first year, they have $132,000 inside this policy of cash value they can borrow right off the bat, okay? Now, I'm going to jump down to year 8. So there's a reason why, and I'll show you this. So in year 8, the cash value in this policy went up by $66,722. But how much did they put in? They put in $48,594, yet the cash value of their money, the liquidity, grew by $66,000. That's pretty cool, okay? So see it right there. What's that mean? That means they had a 37% cash on cash return. Give me a 1 in the chat box if you would like to have a vehicle that has a 37% cash on cash return. By the way, that gets better and better every single year this policy is in existence, which is for your entire life, by the way. So if it's not making sense to you, just focus on that right there. Like that cash on cash return is crazy, okay? That's a very good return on the money. And that's doing nothing, by the way, doing nothing. Just let the money sit there. Now, let's kind of set this on fire a little bit more. So let's say you're going to lend out 12%. You lend out that money at 12%. That's private lending terms, okay? So you lend it out at 12%. Your bank to yourself, your loan to yourself is 5%. So now your cash on cash return is 44% because you put the money to work. So you loan the money to yourself, lent it out to somebody else who paid you 12% on that money. Now your money is working for you in 2 spots. It's working for you in the policy, earning dividends, compounding, right? That's what you're seeing, compound interest. That's why your cash on cash return is so positive. At the exact same time, that same money is in another project or another deal, another opportunity, earning you 12%. So now you're earning 44% by being in 2 places at the same time with the same money. And we did nothing different except where your money goes first, through the policy. Now, if you just did the private lending with the cash, that would be 12%. Be your own banker, it's 44%. So I don't need to ask this question, but I'll ask it anyways. Would you rather have option 1, 44%, or option 2, 12%? Obviously, we would choose option 1, 44%. So that is what happens when you put your money to work for you in multiple places at the same time, okay? Now, this is just a quick slide to show you why this is so powerful, and that's compound interest, okay? So look at this one. This is a $50,000 dump in. So this person put in $50,000 upfront to fund the policy, get it growing quickly. They're also putting in $490 a month. So that's how they're funding it. So in year 2, cash on cash is 21%. Access to capital is 121. Year 10, 54%. Access to capital is 154%. Go down the road a bit. Year 25, cash on cash return is 281%. That's very powerful. Access to capital is 381%. That's the power of compound interest. Uninterrupted compound interest. Yeah. Yeah, Robert. Yeah, exactly. And then Troy, yes, there'll be a recording for sure. Yeah. Yeah, so that's why compound interest uninterrupted is one of the most amazing things if you can get access to it, right? And this is one of those ways. So we're going to get some more stuff here, but this is one thing I want to mention when it comes to the compound interest is like, how do you eat an elephant, right? It's one bite at a time. Another analogy is the man at the top of the mountain didn't fall there. Like when we look at the successful people or wealthy or whatever, and you look at them, they're at the top of that mountain. Oh my gosh, I want to be up there. Well, how'd they get there? They took a step. They took that first step, okay? And so infinite banking is sort of that same thing. You got to get the thing rolling, and then eventually you'll be at the top of the mountain. So, and you saw that on that previous slide right there, the compound interest. So is it possible to owe no man nothing? Yeah, pretty much, if you can get control of everything in your life, right? So the machine works for debt and expenses. So we showed that vacations, homes, taxes, all that kind of stuff. Now, what I want to do is I want to go back really quickly for just a couple minutes to the person that was paying off the debt, the doctor, the 45-year-old male doctor, okay? So if we had paid the homes back, the condo and the home, right, as promised, what would that look like, okay? The condo payment $871 times 251 months would be $220,000, by the way. Gotta love those amortized loans, right? The house is $1,221 at 224 months. That's $273,000. That is $493,000 that you would have paid out for those loans on those properties. But at the end of the day, that's a lot of months down the road, by the way, you would you'd have paid out almost $500,000 and you would be debt free. Okay. But you would have paid out $493,000. Now, when we look at us being the bank, okay, let's just say that we did the same thing, 4% interest, okay, what would that look like inside the policy? So if we paid those into the policies like we talked about, what would it look like? If we were the ones in charge and took over those debts like we showed over the same time period, that money would turn into $749,000. So in this scenario, you have $749,000 and you own the house and the condo outright. In this example back here, same time frame, you just paid back the loans as you normally would. You'd have paid out of pocket $493,000. So if you do the math, that's a swing of over $1 million in the other direction. Okay. That's why when you start to understand how this can work over the long term, it's extremely powerful. Okay. Frank, you don't owe us anything. So there's no cost. So yeah, I'll talk about that in a moment here. But yeah. And there's no cost to it. So once you understand that the time frames, the compound interest, man, it's pretty fun. So if you guys are saying, well, okay, what's that look like when it comes to like maybe an investment, when it comes to maybe buying a car, paying off debts? This is an example of one of the things that we work with you on. So we do this for you. This is called the gain projector, by the way. So if you want to do like if you're going to do an investment, you're going to do a property, maybe it's an investment fund, whatever it is. This will show you how the policy will look and work with that investment, with that opportunity. So if you guys are looking at doing real estate, down the road, yeah, we will show you the best way to funnel the money through the policy and back into the opportunity to maximize the return. So it's one of the things that we do. It's pretty cool. But yeah, it's going to be, it changes the numbers quite a bit. Bottom line, it's really fun when you see the difference between, hey, if I just did it with cash versus a policy, the amount of wealth you have down the road with a policy, with the infinite banking in place, it's sometimes hard to believe. But once again, time and compound interest. Okay. So now that you know about this, I truly believe that everybody should do this. If you can't do it on yourself, show it to other people. One of the biggest things that we do here at the Money Multiplier, and I've been doing for a long time, I've been teaching infinite banking since 2016, is tell other people about it. Show people what this can do. So because if you can really change like the next generation, man, the ripple effect that you can have in not just your life, but their lives is just amazing. So here's the next step, guys. If you want to talk to me personally, one-on-one about how we do infinite banking for you, if you have any questions, things like that, all you got to do is go to brian.beyourownbanker.com. I'll put that in the chat box as well. And that'll allow you to schedule a call directly with me one-on-one. And then I'll also put my email address in here in just a moment as well. So if you guys want to get those free books I mentioned, just go ahead and send me an email and I'll send them to you. All right, so I just put my call link in the chat box. I got more slides, by the way. And if you guys have any questions, please ask questions right now. I love answering questions on this concept, by the way, but there are some other things that I do want to make sure that you are aware of when it does come to infinite banking that are extremely amazing. So let me go ahead and put in my email address as well. All right, there's my email address. So if you guys want those books, just go ahead and send me a quick email and I'll get it over to you. Here's the thing with infinite banking. It doesn't matter if you make $10 per hour or $10,000 per hour. You can get started with wherever you're at. There's lots of different ways to do this. And one of the things that I truly believe is that we need to break the bonds of financial slavery. And some people don't even think they're in financial slavery, but a lot of people are. And you've got to think about what that looks like. How can you change your situation by becoming your own bank, by getting control of your own money? The Rockefellers, the Rothschilds, all these families understand how to control money. And they do it by the way, by taking control away from other people sometimes, which I don't like. So this concept puts that control back in your hands. And I love this picture here because a lot of people, myself included, are on the bottom. I've done that I did that for so long. I felt like I was just, a slave to making money. I was like, man, it was brutal. But once your money starts working for you, completely changes everything in your lives. Okay. All right. So let's talk about some other things that infinite banking does for you. So one, we didn't even talk about the death benefit. The death benefit is a guarantee, by the way, tax-free. And I'll look at some examples here in a moment as to why that is so powerful when it comes to generational wealth. So we're going to talk about that for a moment. The loans that you borrow from the policy are loans that you're in control of. Okay. You're in control. The reason why you're in control is because there's collateral on that loan. It's the death benefit, by the way. So the insurance company who's giving you that loan, it's up to you. So you are in control. You choose how and when to pay it back, or if you pay it back, which we recommend, by the way, that you do pay them back. But yeah, the internal values, they're growing tax-free. Like they're growing tax-free inside the policy. Okay. The policies are exempt from judgments and liens in most states. Not every state, by the way, but in most states, they are protected. It's a protected asset. All right. Tax-free income in retirement. So if you guys want to build a tax-free retirement strategy, infinite banking can be a way to do that. Right. So let me talk about the generational wealth aspect of infinite banking. So I want you to look at the death benefit on the right-hand side. This person is putting in $20,000 per year premiums for 5 years. Then they drop the premiums down after year 5. That's an optional thing that they did. Here's what I want to show you. The death benefit, which is guaranteed to be paid out at some point down the road, hopefully a long ways down the road, guaranteed, is growing. It's always going up. So it starts at $325,000. At year 7, it's almost $500,000. Okay. So think of it. In year 5, this person has put in $100,000 of premium deposits into the policy. The death benefit is $483,000, almost 5 times what they put into the policy. And that's going to keep growing every year. So the point is that why do the wealthy do this? Well, they know they can put in, at like $1 million or $1,000, whatever number you want, but it's going to be worth 5 to 10 times that down the road, guaranteed tax-free. Now you know why the wealthy do this on all of their family members. That next generation, man, it's when you look at the numbers, it's kind of almost sometimes hard to fathom. But once you see it in effect, it's amazing. Okay, let's talk about the policy loans. So this is a question I get quite a few questions on policy loans. So let's kind of talk about that for a second. So one, the loans are guaranteed. There is no credit check. There is no approval. Ask and you shall receive. We show you how to do it, by the way. You log in, request the loan, and it shows up in your account. Pretty much how it works. The loans are also private. It's a private loan. They do not go on your credit report. They do not affect your credit, by the way. Okay, because they're private. It's a private agreement with you and the mutual insurance company. It's a private contract, by the way. Very important. Let me ask you a question on this. This is a great question. So I want you guys to answer this in the chat box. If you have a mortgage with a bank and for your home, who owns the contract? Who owns the contract? Anybody want to answer that question? Who owns the contract? Is it you or the bank? Correct. Mark said, yep, the bank owns the contract. With a life insurance contract, who owns the contract? Essentially, you do. So you own the contract. It's your contract. Yep, me. Yep, we do. Lucy, yep, there you go. Huge difference, by the way. Huge difference. Okay. All right. Next up, with the loans, there is no minimum or maximum payment because you are the one in control. So when you are in control, it allows you to make more money. But with the policy loans, you don't have to make a payment if you don't want to. Now, we typically recommend that you do make the payments back, or at least make the interest payments back, because you don't want to go the other direction with the loans, but you're in control. And so if you're an investor, it puts the control into your hands when you're doing investments. It's very, very different than going and getting like a hard money loan or a traditional bank loan. So you are the one in control. And if you miss a payment with a car company, what happens? They come and take your car. If you're the bank and you miss a payment, nobody's calling you. Nobody's saying, hey, where's the money? Because once again, it's your choice. It's up to you. All right. How can I fund my bank? This is another really popular question. Okay. You can do it monthly, you can do it quarterly, and you can do it annually. However you want to fund it. And you can change that, by the way, during the life of the policy. You can change it if you want, but that's how you can fund it. Now, how much can I put into my banking policy? This is a good question. I get a lot. Well, minimum we recommend is around 10 times your age per month. Okay, that's the minimum to make infinite banking really function well. Maximum depends on your person. So that's mainly based upon your liquidity and your gross income. So if you make like $100,000 per year versus 150 versus $50,000, it's going to be a different maximum. Okay, and that's set by the insurance company, and we walk you through all those numbers so we can look at the best way to fund the policy and capitalize your banking policy. Now, on top of the premium deposits that are going in monthly, quarterly, or annually, you can fund the policy upfront with a large dump in. So it's a very common thing. The reason why is because when you do the dump in, you have a lot of cash value a lot early on in the policy. So like, let's just use an example. Let's say you say, hey, Brian, I want to do $1,000 per month and I want to do, a $20,000 dump in. Well, within the first 30 days of that 20,000 dump in, you're going to be able to borrow 90% of that right out of the policy within 30 days. So it's very fast. So the dump ins are very powerful because they get dividends also early on in the policy and make it very efficient. So it's an optional thing. You don't have to do those. But yeah. And then Anthony said, don't want it to become a MEC. Yeah, correct. You never MEC a policy. MEC means modified endowment contract. That is a limit that we have on these policies where we don't want to go over what's called this limit. Becomes a taxable contract, but you don't need to worry about that. That's what we do. We worry about those, or we don't build them for that. Yeah. Grant says go to work. Yeah, no worries, Grant. Appreciate being here, man. So depends on how we build the policies and what you're going to use it for, but anywhere from 50 to like 90, 93%, 90% of the policy is in cash value within the first 30 days. So I always tell people this, these are not cookie cutter things. They are built for you and what you're going to use the policy for. That's our job here, is to figure out, hey, what are you using this for? How's it going to work? How's it going to function? And then we build it to fit you, bottom line. All right. And then this is also kind of funny. So I always ask people this. I go, would you put $1 in to get $3 out? Because some people are thinking about this. Why would I do this? Why would I just not use, my bank account and just do cash? Well, would you use an ATM that allowed you to put in $1 and get $3 out? Yeah, of course. And I'm going to show you what I mean by that. Anthony, well, one day we'll get a webinar on the difference. We have those. We have a video on because yeah, IULs, VULs, we don't even go into those. They're not infinite banking because they don't even have the same features. They have some of the same features, but some of the things are very different. But yeah, we have some videos already on IULs versus whole life because that question comes up all the time. And then HELOC is different, but you can use a HELOC in conjunction with infinite banking. Yeah, and I've done presentations on that with Joe on our team many times. But yeah, I'll talk a bit about the IUL stuff here in a moment as well. But let's kind of talk about really quickly a policy example of why this thing, when you do the dump into stuff, what it looks like from a efficiency standpoint. Yeah. And yeah, let me share that real quickly. There's my email address right there. And then let me grab my link again. So yeah, so if you guys want to schedule a call with me, just go to brian.beerownbanker.com. That's my personal call link, by the way, or click it right there. I put it in the chat as well for you. Okay, so this is an example of a female, 32 years old. And you can see on the upper right-hand corner, they're doing an annual premium of $10,000. That's just an example. And they're also doing a dump-in or lump sum of $50,000. So you'll see in year one, they put in $60,000. At the end of the first year, the cash value is $55,000 and change. That's what they have at the end of the first year. Now, let's look at it down the road. Look at year two. Now they put in $10,000. At the end of that year, they have $10,607 of growth in the policy. So they're already cash on cash positive. Make sense? Let's look at year 11. Now we drop the premiums down after year 7 or year 10. So you don't have to do that, but we just show it dropping down. Now this person puts in $3,120 and the cash value goes up by $10,590, more than 3 times what the person put in. So would you like to have a vehicle where you can put in $3,120 and take out $10,590 and still have the growth, still have the compound interest, all that stuff at the same time? Give me one in the chat box. You guys want to have that kind of cash on cash return. And as I said, it just keeps getting better and better every single year. That's that compound interest, uninterrupted. Yeah, Liam said, yeah, the one right there. Okay. Now, this is a quote that Warren Buffett says, and I'm not quite sure I like it, but it's an interesting quote. And it says, if poor people would just do what rich people do, they wouldn't be poor anymore. Now, I will say this, with infinite banking, it's not a fit for everybody. I will never say that it is. I will never say it's a fit for every single person. But if you want to be one of those 5%, infinite banking is one of the most powerful ways to do that. Yeah. And then somebody here said, yes, Robert, it is definitely being recorded for sure. And then Anthony said, can you say what the riders are? So there's different riders, depends, Anthony. But yes, so there's a couple of PUA riders, and there's a lump sum PUA rider, and sometimes a 7-year term rider. Those are some of the ones that we do use. But it depends on the person and and the structure of the policy. Yes, Anthony, I like that. I like that way too as well. Yeah, I like that way. Now, why should you work with me? So here's the thing. So obviously the money multiplier here, we have a fairly large team, but I've been teaching infinite banking for now about 8 years now. I even built a course on it many years ago with another person. Yeah, I've helped thousands of people do this. We have an entire team that works with you to set up IBC. So a lot of times what happens, and these are the horror stories that I get every week. Somebody goes to someone down the road, they go to this person over here and says, hey, can you set me up with this kind of a policy? Yeah, sure I can. Well, here's the first thing. Here's the first thing. If you're going to go work with somebody, it doesn't matter who it is, whether it's me, someone on my team, or somebody else, ask them how they use the policies. Ask them if they're doing this. If they're not doing it, then why would you want to buy that from them? Because that's like going and going to a Ferrari dealership to buy a Ferrari, and yet the guy selling you the Ferrari, he drives a Honda Accord because he doesn't know how to drive a Ferrari. How can he teach you how to drive the car if he doesn't drive one himself? That makes sense? Yeah. And Tess is on our team, by the way. And she was a client first, and now she's on our team, which is amazing. And she's got a lot of cool stories and stuff. But yeah, so we have an entire team, about 30 to 40 people that work with you. Our team is the largest IBC producer for some of the insurance companies that we work with. So we have anywhere from 600 to 800 people in underwriting at any one time because we have a full team. We have a lot of repeat clients. We got a lot of people like Tess, and we've got a lot of referrals, by the way. So yeah, so we have a very large team that does just infinite banking. Don't talk to me about an IUL, a VUL, a car insurance, or home insurance. We focus on infinite banking, and we do that very well. Yeah, exactly. Yeah, Anthony's still learning, always learning. I personally, I think I have about 100 clients in underwriting right now. We also do ongoing support and services. This is very unique to infinite banking. A lot of people, when they go and get a policy, they don't know how to use it. That is a very unfortunate thing. And I've come across someone who had hundreds upon hundreds of thousands of dollars of cash value in a policy, and they did not know how to use it. In fact, they didn't even realize that what it could do because the agent who set this up with them didn't tell them how to use it. And that agent, retired or whatever it is. So we have a whole team that supports you on an ongoing basis. We have the implementation team. Once you have a policy in place, we are going to show you how to use it. If you have questions about it, hey, how do I flow the money through this or this or this? Reach out, we will show you. And there is no cost. We don't charge you any fees for that. It's just part of what we do because you have to be a good banking practitioner, as we call it, and a good banker, an honest banker, and we will teach you how to do that. All right. No cost to you. We don't charge you anything. So here's the thing. We are infinite banking practitioners, but we are not, I'll never say that I'm a life insurance salesperson because first off, don't sell anything. We just talk about it. We teach it. Hey, if you want to come talk to me about how to put this in place, I'll help you do that as well. That's what we do. We put it in place for you. But we also are entrepreneurs. So I own businesses. I own a golf ball business of all things. A lot of us do real estate. We do other things. Okay. So we use this in our own lives first, and now we will show you how to do it as well. And we do, Tess is on all of our stuff. We do ongoing webinars every week. We do an Ask Me Anything. That's actually tomorrow at 4:30 Eastern, where you can hop on with myself and other team members and ask any questions you want, and we'll answer them live. So it's a really good way to keep that knowledge going. All right, this is the question we always get. Is IUL or a VUL, which is indexed universal life, or variable universal life, infinite banking? Are those infinite banking? No, they're not. Okay. IULs and term insurance pay some of the highest commissions also. Gee, I wonder why they are being pushed a lot. They're being pushed a lot because high commission. Also, what's been going on the last, call it 13, 14 years? The markets are going up. What happens when the markets are no longer going up to your IUL or VUL? It can go down. Okay. The big part of infinite banking is to have control and remove yourself from the volatility of the markets, the volatility of Wall Street, so that you have certainty around your money. If you want to risk your money, if you want to have uncertainty about how it's going to work down the road, IULs, VULs, go for it. We don't touch those. Additionally, If you go to the Nelson Nash Institute, which Tess just passed the exam, that's awesome. If you go to that institute, which is the kind of the core of all of this, they won't even talk to you if you're doing IULs or VULs. They actually will kick you out if you even do them. They will not let you be part of their organization because risk, the way they're structured, lots of reasons. We have videos we've done on all those. But yeah, so no. We take a 70% cut in commissions to do infinite banking versus traditional whole life insurance. Why is that? Well, we are reducing, I'm not going to get into the whole semantics of it, but we are shrinking the death benefit, shrinking base premium, and we are maximizing what is called PUAs or paid up additions, which grows the cash value. Very different structure, but that reduces our commission. Okay. This is why, by the way, a lot of agents that you might know or talk to will tell you, oh, you can't do that. It doesn't work that way. Or no, you can do it, but you don't get cash value for the first 3 years. If they say that, run away. Just run away, because that's not infinite banking. I have literally had insurance agents on these calls and they've called me up and said, hey, Brian, I've been an agent for 30 years. I didn't know you could do this. And I show them how, and they're like, oh my gosh, I didn't know that you could do all this kind of stuff. Yeah. That's awesome. Norma, so what is this type of policy called? So it's the long term is called a dividend paying permanent whole life insurance policy, specially designed with a mutual insurance company. Okay, we only use mutual companies. There's only a handful of them that do this concept. We don't do stock companies, by the way. And the last thing I'll mention here is our team only does infinite banking. We don't do anything else. Like I said, we don't do car insurance, home insurance, stuff like that. We're investors, we're entrepreneurs and business owners, and we do just infinite banking, by the way. So that's all our team does. Now, one of two things will happen to us in life. Okay, this is what's going to happen. One, we're going to live like we all are today, right now, right? So when you look at infinite banking, are we better off with that in our lives when we're alive? Sure, I hope so. And then, of course, we die. So are we better off with this in place when that happens or not? Well, I want to do both, by the way. So that's what we always say is that it's not one or the other, it's both. Now, this is kind of a thing I always share here. And this is, I talk to a lot of people. And so when I do that, I kind of see like this tale of two people, I call it. And there's one group, and that's group one. And that's the group that just says, you know what? I don't need anything. I'm going to keep doing what I'm doing. I'm going to, bury my head in the sand, all that kind of stuff. And I was that group, by the way. I was that group for a long time, and it sucked. I was actually getting wealth stolen from me, right? And when you have big changes in the markets, that's the group that loses typically, right? Wealth is ripped away from them because wealth is always being transferred, by the way, from one side to the other. It's always moving. Money is always in motion. Okay. Then there's the other group. The group is the people that learn new things, that want to gain knowledge about new concepts, new strategies. And when they do see new things, they take action. It's the action takers. And that's the people that benefit when wealth is transferred. And I've been through recessions and I've seen it happen time and time again. And I've been on both sides of it now, by the way. And man, I want to be in group two. So if you guys want to be in group two, give me a 2 in the chat box. Okay. Give me a 2 in the chat box if you want to be in group two. If you want to be in group one, you can put a 1 in the chat box if you want to. But Ron said 2, Karen said 2. Yeah, group two is awesome. I mean, group two is where you're always mastering new things in your life. Yeah, Frank, I appreciate you being here as well, man. Yeah, so, and by the way, group two, when I talk to these different groups and I see them, there's a couple big differences. One is the group two people have a purpose in life. They know their purpose. And that purpose typically is bigger than them. Like I have a purpose in life. And when you have that, man, it makes taking action very simple, very easy. And I'm a mindset coach, by the way, too. So I love helping people with their mindset. If anybody wants to talk about mindset around money, around wealth, schedule a call with me, by the way. I love to talk about that kind of stuff, but because I was on the other side, by the way, and I had to change my mindset. And it was not a simple thing. It was easy once I realized how to do it, but someone had to point it out to me, if that makes sense. And yeah, I mean, no one points it out. It's kind of hard to change your mind. All right. So obviously group one, that was me, by the way, going alone. I did that for so long. And then group two, right, is just take some action, take that first step. If you want to be at the top of the mountain, just take that first step. There's no cost to anything that we do, by the way. So you never pay anything to us. There's no fees, nothing like that. It's just time. So hop on a call with me. Let's go through your questions. Let's go through what we're trying to solve. Like what's the thing that we want to use infinite banking for? And let's see if it is a fit for you. That's really all it is. Yeah, Anthony, I used to follow him probably about 4 or 5 years ago. I used to follow Brendan quite a bit. I haven't seen him a lot online anymore, but I know he's still out there doing his thing. Yeah, I like this stuff too. And I've been to Tony Robbins events and those kind of things too. I like the Tony Robbins stuff. A lot of good stuff there. But I'll end on this quote right here. The problem in America isn't so much what people don't know, it's what people think they know that actually isn't true or just ain't so. So there's a lot of things that I've had people tell me that that's a scam or that's not true. And then I literally, these are agents, by the way. And I open up my thing, I run a report, and I show them an illustration, and they're like saying, "Oh, okay, apparently it is true." In fact, about 3 months ago, and at Tesla, appreciate this one. I think I may have shared this with our group privately. So Dave Ramsey. Dave Ramsey is the buy term, invest the rest guy. He's anti-infinite banking. Gee, I wonder why, because he owns term insurance companies, by the way, right? It's kind of a backwards way of looking at it. I was on a call with some people as a couple going through the concept, and I brought up an illustration, and they're like, "Oh my gosh, this is amazing. This is so cool." Then they told me at the end of the conversation, they were Dave Ramsey coaches, and they were like, they knew that something wasn't right. They said, "No, this infinite banking thing sounds amazing," and they hopped on with me and was saying, "Oh my gosh, what we've been told and what we thought was completely not true." They were coaches for him, and they still were coaches at that time, and yet they were doing policies with me, which is the exact opposite of what he talks about. It was hilarious. I've also had a lot of agents that didn't know that you could do this, or they've had policies that were set up incorrectly. And then, another thing that I get, I don't have a slide for it, but there's if you have policies that are like IULs or VULs or like traditional whole life that have cash value, but they're not very efficient policies, you can roll that cash value over into a infinite banking policy. Yeah, it just has to make sense for you. And so I've actually hopped on calls with people, and I said, "Hey, show me your current policy," and we maybe move it over to a new infinite banking policy. So you can do that, by the way. So I get that question quite a bit, but we only would do that if it would make sense. If your policy is already efficient, already doing well, I wouldn't recommend it, but we can always look at your situation and see what makes sense. So keep that in mind. Yeah. Yeah. Frank says, I don't trust Ramsey. Yeah, I don't trust him either. If you look at some of the stuff that that he owns, it's very self-serving. So if you say, "Oh, that's trash, that's trash, that's trash," buy term, invest the rest. Well, if you go to Ramsey Financial, whatever it is, it's selling term insurance. So term insurance is I think it's the most profitable insurance that exists because it only pays out like 1% of the time because you have to die for you to win. So that's not a very good bet right there. But yeah, it's very, very profitable. So yeah, that's why they pitch it. So. All right, guys. So that's the end of the presentation. If you guys got any questions, obviously, type them in right now, and then I'll put in my information one last time. You can always email me if you have questions. If you want to hop on a call with me, go to brian.beyourownbanker.com. And we do have a lot of other resources that I can share with you if you guys want to reach out. We have other videos. We have a lot of other trainings. The Ask Me Anything tomorrow. We have the Wealth Wednesday webinar that Chris does on our, he's our main guy. He does that on Wednesdays as well. I definitely recommend that you check those things out there, because it's just a lot of knowledge that I definitely recommend. And we also do things and share knowledge about what's going on in the economy right now. Why are we at where we're at, and what's happening right now with the dollar? What's going to happen with real estate? We are always learning and sharing that stuff with everybody. So yeah, Anthony says, yeah. They didn't like me since they asked for a credit card for their product, and then I started arguing. Yep. They're always selling something. Yeah. So yeah, there's nothing. So by the way, yeah, there's no fees. There's no I'm never going to ask you for a credit card. That's not the way we work. It's just it's obviously if you want to do a policy with us, we'll help you do that. Yeah, Troy, I'll try to grab your information here. But yeah, you just reached out to me too as well. No digital dollar. Yeah. Yeah, cryptocurrency. There you go. Yeah, we actually even do some stuff on crypto, but I don't invest in that anymore. I have in the past. I actually built a course on cryptocurrencies back in the day. Oh yeah, so Anthony, so we help with that kind of stuff too. If you have a 401k, it depends on the custodian and the rules the 401k custodian has. So if you're with the current employer, you're limited, right? You're going to be limited on what you can do with it sometimes. But some custodians will allow you to pull money out or cancel it or move it even if you're with that current employer, you just got to ask them, call up and ask them. Yeah, so just call them up and ask them. I actually had somebody here recently that they were able to pull the money out of the policy, like permanently. And that's not a common thing typically when you're still employed with that employer. But you just got to ask them, yeah. Same with an IRA. But if you're over 59 and a half, that might change it a little bit, because if you pull it out, you don't have to pay that. There's no 10% penalty in most cases. It's just the tax implications. Yeah. But a lot of times what people do as well, if they look at an infinite banking, they say, hey, Brian, how do I capitalize the account? How do I fund the account? There's lots of ways to do that. So if you're putting money into a qualified plan, as we call it, which is a 401k, IRA, things like that, you can just redirect the funds if it makes sense, not financial advice. If you can just redirect those funds into the policy so your cash flow doesn't change. But it's very different though. When you have an infinite banking policy, you can borrow against it versus the 401k. When you borrow it, it comes out of the account, and there's structure there and all that kind of stuff. Yeah. So that definitely does happen quite a bit. But yeah, if you have questions on that kind of stuff, if you have questions on, hey, if I've got some debts here, or hey, I want to go, I want to buy a car, hey, I want to pay for my kids' college education. Yeah, just schedule a call with me, go through it. And one thing I also mentioned too is that with infinite banking, it's very versatile. You can own a policy on somebody else. You don't have to own it on yourself. It can be on a spouse, it can be on adult kids, it can be on, juveniles. I have a family right now, a grandparent is setting up policies on the 2 adult kids, or one's the kid, one's the in-law, and then all 5 kids too at the same time. So you can do that kind of stuff. It's very, very versatile. Troy, can you own one on an 86-year-old? I'm going to say no on that one. So the reason why is that you got to look at it from the insurance company's perspective. Okay, so what they're doing is you're going to fund the policy for future value. So what you're kind of removing the infinite banking concept for a second and just focusing on life insurance. It's replacement value of a human life. At 86, we're typically not working or not generating a lot of income, so there's not a lot of future value to replace. Additionally, if you're beyond the average life expectancy, then it's very hard to insure somebody, because this is me being honest. I'm very blunt, by the way, on with people. It's, as I said, we're not selling anything. The chance of them passing away is extremely high. And so the insurance company, if they, let's say, accept $1,000 premium with a $100,000 death benefit, the chances of the insurance company losing money is very high, and they can't do that. That's very risky. So most cases, no. But I have lots of cases where people in their 80s they have policies on other people. So let's say this is a real life example. This person has a lot of capital, so not quite 7 figures, but close to it, in their 80s, and they want to pass that money on. They want to do it in a very efficient way. They're opening policies on a lot of the family members, funding those policies with that money. And then once they pass, then the policies can then transfer ownership to those that are insured. So that's an interesting thing about these, is the owner can be different than the insured. Now, kind of gotten in the weeds a little bit there, but yeah. So I've done that many times, Troy. Yes, Troy, you max fund the policy at the beginning. That's typically what we do. Yeah, we typically are max funding the policies at the very beginning, right off the bat. Yeah, that's called a HEC-V, by the way, high early cash value. And that's the kind of policies that we build, is ones that are maximum funded cash value maximum at the beginning. Troy, so there is no payment needed. Yeah. So there's always a premium deposit you're funding the policy with. That's the quarterly, annual, or monthly, quarterly, or annually. You're gonna want to continually fund it, and I typically recommend that you want to fund it as much as possible in the first 7 years. After that, you can start dropping it down to 40% or 0. But yeah, you might be talking about like single pay premium policies. Those ones don't function very well as infinite banking, but they're possible. You just typically don't do them. 100-year mortality rate. Yeah, it's that or 121. Yeah, so the policies are typically 121 years, meaning they mature at age 121. It's kind of funny. Yeah. All right. I think that's all the questions we got there. Anthony, great question there, by the way. Do you believe in putting a trust on it? In most cases, yes. Yeah. So this is a common question we get a lot is, hey, can I put my policy in a trust? Yes, you can. A trust business can be the owner of a policy and the beneficiary. So the situations where you do that are like, let's say you're a family and you want to create generational wealth, 5, 10, 15, 20, 30 years, 200 years down the road. You can do what's called a family trust, where the trust owns policies and is the beneficiary as well. And so you keep that money coming back into the trust, and then the trust then functions and operates based upon your wishes. So yeah, so we do that quite a bit. And you can change the ownership of a policy at any point down the road. So oftentimes what people will start a policy, and then down the road they'll create a trust and move the policy ownership into the trust. JD, great question right there. Should you do both an IBC, infinite banking concept, and velocity banking at the same time? Yes. My opinion is 100%. Yeah. Yeah, you can overlap those ones for sure. And Christy, one of our team members on our team, she does a very good job explaining that concept too, is velocity banking. And then and by the way, we do have resources for HELOCs and things like that too. And for trust, we have Christy Van. Yeah, correct. We do have a network. So if you guys are looking for legal advice or CPA services or trusts or entity creation, all that kind of stuff, we have a full network. I personally work with Robert Kiyosaki's advisors as well. So by the way, I learned infinite banking from one of Robert's advisors. So that's kind of cool how I learned about it. And then JD, so yes, return here now. Christy Van, yeah, for sure. Are your HELOCs first position? Maybe with First Savings Bank of Tennessee. Yeah, so it's First Savings Bank of Tennessee is one of the ones that we use, and they can be first lien positions HELOCs. Yeah, there you go. Yeah, for sure. Yeah, so I've walked people through that concept. So it's if you guys don't know, so a first lien HELOC is where you don't have a mortgage, you only have a HELOC. And most people don't know this, but you can buy a home with a HELOC. You don't have to buy them with a mortgage. You can buy them with a HELOC. Different structure, different loan structure, but you have to understand velocity banking to understand why I'd even say that. But definitely check out Christy Van's Fantastic Finance on YouTube, her channel. She talks about that whole concept. But yeah, I mean, if you understand how a HELOC works and an amortized mortgage works, it's a great question. Would you rather have a 9% HELOC or a 3% 30-year mortgage? It's kind of a trick question, right? It's like, well, 9% is going to be a higher payment, but if you're doing velocity banking, you'll pay the home off in 6, 7, 8 years, something like that, versus 30 years with a mortgage. And you'll pay significantly less as well. So yeah. All right, everybody. Well, have a great rest of your Tuesday. Have a great week. And for those of you that are scheduling calls, I look forward to talking to you as well. All right, everybody. Take care.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.